What if I told you the most valuable dairy brand in the world isn't Nestlé, Danone or Lactalis, but a Chinese company you've probably never heard of? It's called Yili Group. Based in Inner Mongolia, Yili supplies dairy to over 1 billion consumers across Asia, and yet it remains largely unknown in the West. From Olympic sponsorships to science-driven innovation, from industrial efficiency to consistent investor returns, Yili is a case study in long-term Chinese execution. In this video, we'll break down how this company became a dairy empire and whether its business model still holds up. As always, this video is not financial advice, so always do your own research before investing. Let's dive into it. Yili's story starts in 1956, in the cold steppe city of Huhe, Inner Mongolia. At the time, it was a small state-run milk provider in a planned economy. But everything changed in the 1980s, with Deng Xiaoping's reforms. China was opening up, and so was its appetite for dairy. In 1993, the company officially became Yili Group and listed on the Shanghai Stock Exchange. It quickly capitalized on the rise of China's middle class and its growing demand for milk-based products. The real breakthrough came in 2008, when Yili was named the official dairy supplier of the Beijing Olympic Games, a milestone that anchored the brand in China's national identity. That same year, however, the company faced a serious test of its credibility during a nationwide food safety crisis. The incident forced Yili to overhaul its quality controls and rebuild consumer trust, a turning point that would shape its future strategy. Yili means quality. That slogan wasn't just branding, it was strategic. And it worked. Over the next decade, the group's revenue nearly doubled. Revenue climbed from 60 billion to over 126 billion RMB, before slightly dipping in 2024 due to weaker consumer demand and rising competition. But make no mistake, this is still a national champion, deeply embedded in the country's soft power strategy. So what makes Yili so efficient? The secret isn't just branding, it's industrial execution. Yili doesn't own huge herds of cows. Instead, it partners with thousands of dairy farmers across China, providing them with tech, training, and strict quality control. It's a kind of light vertical integration. Yili controls the system without owning every asset. But where the group really stands out is in how it industrializes everything. Different flavors, formats, packaging, all optimized for micro-targeted segments: kids, athletes, urban elites, and rural families. Milk becomes a segmentation weapon. Here's a breakdown of what it costs to make a typical Yili dairy product. Nearly half of the cost comes from raw milk. Then you have energy, packaging, marketing, and just a sliver for R&D. And if we zoom in further, you'll see that the raw milk cost is dominated by feed: maize, soy, and forage. That means Yili's profitability is highly exposed to agricultural commodities. Between 2015 and 2020, gross margin stayed solid, around 37 to 38%. But in 2021, it dropped sharply to just 30.8%. Why? Overproduction, price cuts, and a slowdown in liquid milk sales. Since then, margins have slowly recovered, thanks to better mix management with premium segments like infant nutrition. Bottom line, Yili's strength lies in designing margin through industrial precision. And in Q1 2025, gross margin continued to improve, reaching 37.7%. But volume stayed under pressure, with liquid milk and ice cream still declining. Yili isn't just a milk producer, it's a nutrition company, and it invests accordingly. Across China, Southeast Asia, Europe, and Oceania, the group operates 15 innovation centers. Their focus: probiotics, fermentation, infant nutrition, and even AI-assisted product formulation. One of Yili's flagship projects involves replicating complex compounds found in human breast milk. The result? Premium infant formulas like ProKido Ruehu, which now lead the high-end nutrition segment. This R&D isn't for show. It fuels a clear strategic direction. Move up market, innovate through science, and escape the low-margin battlefield of mass dairy. Conquering China was never the end goal. In 2013, Yili acquired Oceania Dairy in New Zealand. 5 years later, it bought Westland, the country's second largest milk producer. It also expanded into Southeast Asia via Chomtana, a leading Thai ice cream brand. But Yili doesn't just export. It produces locally, tailors its formulas, adapts its packaging, all while keeping a centralized Chinese-style management model. Harvard Business Review called it a glocal machine, global in ambition, local in execution. And it's working. In 2024, international infant milk sales jumped 68%, and ice cream rose 13%. Not game-changing, but clear, consistent traction beyond China. Let's talk margins. You saw earlier that gross margin took a hit in 2021, but something unexpected followed. EBITDA margin, the true measure of operational profitability, actually kept rising, from 11% in 2020 to over 14.5% in 2023. Why? Cost discipline. Yili cut admin expenses, streamlined logistics, and automated production lines. That efficiency translates directly into cash. Free cash flow soared from just over 3 billion to almost 18 billion RMB in 5 years, and free cash flow per share has quintupled. You can see it here. In 2019, CapEx peaked at 9.2 billion RMB, heavy industrial expansion. After that, investment normalized and cash generation accelerated. It is also building tangible value. About 20% of its shares' worth comes from fixed assets, factories, equipment, and warehouses. So yes, it's a capital-intensive business, but a highly disciplined one. Between 2021 and 2024, net debt moved from minus 10 billion to plus 19 billion RMB. That might sound alarming, but it's not due to excessive borrowing. Yili parked over 25 billion in term deposits and over financial assets that aren't counted as cash under accounting rules. Earnings per share had been rising steadily until 2024, when it dropped by 19%, from 1.64 to 1.33 RMB. This decline wasn't caused by a collapse in margins. EBITDA margin actually stayed relatively stable. The real reason was the drop in revenue. With 8% less top line, total profit naturally shrank, even with good cost control. What's not shown on this chart, though, is the 1.28 billion RMB goodwill impairment tied to House Nutria, a Chinese-Dutch infant formula company initially acquired by Yili in 2019 and fully consolidated by 2021. That's a separate accounting hit, and if you strip out non-recurring items, earnings per share weren't really 1.33 RMB. They were just 0.95 RMB, a much steeper fall and a clearer view of the pressure under the surface. And in Q1 2025, net profit declined again, by nearly 18%. This time, it wasn't an accounting adjustment, but a real hit from high operating costs and soft domestic demand. Return on equity also fell from over 25% to just 15.8%, still solid by global standards, but clearly off its highs. Now this part investors will appreciate. Yili currently pays a dividend yield of over 4%, with a payout ratio about 90% in 2024. That's not your typical tech stock, that's a disciplined cash return machine. In fact, between dividends and share buybacks, Yili returned 100% of its net income to shareholders last year. So, is the stock cheap today? Let's zoom out. This chart shows Yili's share price versus its long-term valuation trend. Right now, it trades between -1 and -2 standard deviations below its historical regression line. On paper, that suggests undervaluation, but the story is more nuanced. Yili's golden decade was driven by rapid urbanization and booming dairy demand in China. But that phase is over. The market has matured, growth has slowed, and margins are now under pressure. Based on its 2024 results, Yili trades at around 21 times earnings. But if you factor in Q1 2025, with an over-profit decline, the real multiple jumps closer to 24 times. That's actually higher than many global peers. For instance, Danone currently trades at around 21x earnings. So yes, Yili may still look solid on paper, but it's trading at a premium while facing slowing demand, falling margins, and earnings are now back at 2020 levels. In light of all this, it's worth taking a step back. So where does that leave Yili? It's still a credible company, a well-oiled industrial machine with consistent execution, a clean balance sheet, and generous shareholder returns. 2024 marked a clear slowdown, and Q1 2025 confirmed it. Margins under pressure, revenue declining, and earnings now back to 2020 levels. Let's break it down. In the short term, demand has been hit by elevated youth unemployment and weaker purchasing power among younger consumers. Dairy is still considered a semi-premium product in China, so many buyers are cutting back and choosing cheaper alternatives. Still, if the macro environment stabilizes and consumer confidence improves, especially among younger buyers, we could see a rebound in dairy consumption. Yili will likely grow in line with China's GDP, around 4 to 5% a year. It's no longer a high-growth stock, but that's not its role. Yili operates in a quasi-duopoly, with limited disruption risk and strong consumer loyalty. It's a defensive asset by design, the kind of stock you build around. Like a holding midfielder in football or a second-row forward in rugby, it won't make headlines, but it lowers volatility, absorbs shocks, and delivers under pressure. Despite the drop from its January 2021 peak of 49 yuan, at today's price, the stock still looks too expensive to me. Personally, I'd be interested in Yili at around 15 times its normalized earnings from 2021-2022. It might take a while. I think we'll probably have to wait until late 2026, maybe even 2027, for earnings to return to that level. Based on an average earning per share of 145, a 15x multiple gives me a fair entry point around 22 yuan. So for now, it's a stock I'm keeping on my watch list, just waiting patiently to see if it ever reaches my buy zone. But until then, it's staying out of my portfolio. If you enjoyed the breakdown, feel free to like, subscribe and share this video. And let me know in the comments what company you'd like me to cover next.